Now, as a cannabis business operator, you understand that cannabis business taxes can be quite complicated. You have 280E tying your hands together, only allowing you to deduct the cost of goods sold from your revenue to create that taxable base, and that exposes you to a lot of taxes. Now, one thing that you need to think about is how can you back your sales and marketing expenses into the cost of goods sold? And in this video, we're going to teach you how to use intellectual property and royalty agreements to do just that. Now, if you have any questions about this particular tax strategy or cannabis business accounting, then please reach out to us via our website at greengrowcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation. Today's topic is going to be reducing cannabis business taxes with IP and royalty payments, and this presentation is brought to you by Greengrow CPAs. Now, as a cannabis cultivator or manufacturer, you're tasked with managing not only products and their quality, but also all the costs associated with your business. You look through your P&L and you see your sales, your direct cost of goods sold, overhead like utilities, rent, depreciation, and equipment, and you see some level of predictability around those numbers. From there, you're typically left with sales and marketing expenses, and you ask yourself, hey, how can I have those expenses actually work for me? Because sometimes those make up 5 to 10% of your sales. So for a $10 million cannabis company, that could be close to $1 million in expenses that you can't roll into COGS, which means there is a big opportunity to unlock those deductions. So in this video, we're going to explore how to unlock your sales and marketing expenses from 280E. A little bit about Greengrow CPAs before we dive into the content here. Now first, we are a cannabis-only tax preparation and finance firm. We have hundreds of active clients throughout 12 states in the USA, as well as international clients in Canada, Europe, Australia, and many other countries. Now yes, we do tax preparation, we also do tax strategy planning, we do audits and business valuations, financial compliance, outsourced CFO work to help you get a grasp on the numbers for your business, as well as IPO readiness. So if you're ready to go to the public markets, we can help you prepare for that. And we service all verticals in the cannabis industry, from cultivation, testing, manufacturing, distribution, retail, delivery, everything cannabis and finance. That's what we can help out with. Now, before we get started, I need to let you know that the information contained in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not provide any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's review what we're going to cover in this presentation. So first, we're going to talk about the big tax problem that cannabis businesses face. Then we'll talk about and outline a potential solution for those tax problems. Then we'll show you an example fund flow, then discuss how the taxes work. We'll discuss those royalty payment structures. I'll give you an example tax savings, and then help you understand the exposure of taking on and using this potential strategy. So first, the tax problem that cannabis businesses face. So as you know, 280E restricts the deductions to only cost of goods sold. And there's a strict interpretation for what those direct costs can be, pretty much just the packaging and the raw materials. So you're left kind of tied with your hands together on what you can deduct, which exposes you to a lot of tax burden. Now, you need to market and sell your products to get awareness and make your business profitable. And often, again, you cannot deduct these costs, so this destroys your profitability. So the big question that we all face as cannabis business operators is, how do you back as many costs, specifically those sales and marketing costs, into cost of goods sold so that you can deduct them and lower your tax burden? So let's explore one solution to this cannabis business tax problem. And the strategy that we're going to describe here can work for manufacturers and cultivation operations and even those vertically integrated businesses. So first, what you're going to want to do is create a separate entity that owns your intellectual property. Now, when you think of intellectual property, you probably think of trademarks, images, slogans, logos, things like that. But intellectual property also includes things like trade secrets, recipes, techniques, formulations, patents. Okay, those very valuable things that are not the sexy things like a brand or a logo, but those are considered intellectual property. Then the operating entity pays a reasonable royalty to the intellectual property entity. Okay, now you roll this into cost of goods sold, and we'll show you how this works later in the presentation. So then the intellectual property entity books that royalty as revenue, and now they have cash to run their own fully separate business. And this intellectual property entity will perform all the sales and marketing functions for the operating entity and the products that it produces. Now, it also has expenses to offset this revenue and hopefully netting down as low as possible. You'd love to hit zero, you don't want to go negative, but you want it to actually hit some type of lower number to offset and unlock that royalty payment from 280E as full as possible. Now again, this strategy works for manufacturers, cultivators, and vertically integrated businesses, and it's less helpful for those standalone dispensaries or deliveries. So let's look first at an example fund flow so you see at a high level how the money moves around and how this impacts your tax burden. So on the left-hand side, you see the old model or your current model right now. You have revenue flowing into your licensed operating entity, which is a manufacturer or a cultivator. And then you have below that some expenses. Now it breaks out into two different ways. You have cost of goods deductions, things that can be considered cost of goods, and then you have non-deductible costs, your SG&A costs, again, sales, marketing, office supplies, basic things like that. And then it all breaks down and funnels into a particular tax burden for the year. Now, the new model on the right-hand side of your screen has two separate entities. Now, you still have that licensed operating entity, which is a cultivator or a manufacturer, and you have revenue coming into that entity from them selling their products. Now, what you see between these two entities, which that one on the right is the intellectual property or brand entity that does all the sales and marketing for the licensed operating entity and their products. Now, again, between those two entities, you see that the operating entity is going to transfer all their intellectual property rights over to the brand and intellectual property entity. And that licensed operating entity is also going to pay a royalty fee to that intellectual property entity for rights to use that intellectual property. And that royalty fee is considered revenue for the intellectual property entity. Now they have operating capital to do the sales and marketing for that other business. Let's go deeper into the licensed operating entity. They're going to have expenses, still have expenses, right? But their COGS deduction will go up and their non-deductible costs will go down, because we're going to show you in this video how that royalty fee can then be pushed from non-deductible over to a COGS deduction. And essentially this will reduce the tax burden for that licensed cannabis business. Now on the right-hand side, that intellectual property entity that does all the sales and marketing, they're going to have expenses, and they're going to be all deductible expenses because this is an ordinary business. This is not a cannabis business. It is not plant touching. And then they'll have their own separate tax burden under that. So that's how the old model and the new model compare to each other. So now that you understand how the money in the operations flow, let's go deeper into how do taxes work with this particular arrangement. So again, the cannabis manufacturing or cultivation business, they will pay a royalty once per month to the intellectual property entity, and it will become fully taxable income for the intellectual property entity, but the entity will have its own sales and marketing expenses and operating expenses to offset that income. Now, essentially, this new intellectual property entity does all the sales and marketing functions that you used to do in-house for your manufacturing or cultivation business. But going forward, the manufacturer just licensed the intellectual property, things like the trade secrets, the recipes, the techniques, the formulations, to just make the products, and that's all that they do. And then the intellectual property company does all the sales and marketing for those products. So that's how the operations and the money works. Now on to the taxes. Now, for the manufacturing or the cultivation company, the big question that they have and what they need to understand is how do they allocate that royalty payment into COGS so that it can be deductible? Now, there's a lot at stake here in tax savings. If you get this wrong, you could be paying, again, 30% tax rate or whatever your tax rate is on a $1.2 million tax payment. Now, 30% of that is $360,000. Now, if you get this right, that's $360,000 in tax savings. You get this wrong, and now you're still paying that $360,000 in taxes every year. Now, the main pillar is to focus this royalty payment on the manufacturing or cultivation procedures and methodologies. And as stated earlier, the intellectual property that you're licensing includes trade secrets, recipes, techniques, and formulations. Now, it should be understood that if you didn't have these pieces of intellectual property, then you couldn't make your product to specification or to the level or standard that it needs to be at. So it's incredibly important that you have well-documented SOPs to become your trade secrets and your techniques. Because without this SOP or any of these big documents, you will have a hard time with this strategy. So let's dig deeper into taxes. Now, the IP company should make this a sales-based royalty fee to the manufacturing or cultivation company. And this is where tax code 1471 is most applicable and where we would get our guidance from. And yes, 1471 is pretty broad, but it does bring up that indirect production costs are inventoriable costs, and we will get more clarity on what those costs are by looking at another tax code, section 263, which is also called UNICAP. Now, in section 263, there's a list of non-exclusive indirect costs that must be capitalized, and those include manufacturing procedures and special recipes. So your royalty can be added to COGS as long as it is a manufacturing procedure or special recipe that is necessary or directly benefits the production or the resale of this product. But it doesn't stop there. Understand that you must use a GAAP accrual accounting adjustment to move those costs from inventory into COGS as you sell those products for every period in which you sell those products. And we made another video on this accrual adjustment and how to move costs from inventory into COGS, and I'll link to that in the description below this video. So now that you understand how taxes work and how you can actually roll that royalty payment into cost of goods sold, let's talk about the payment structure and royalty payment amount. Now, there are two benchmarks that we'll use to triangulate a number, and those are your financial projections for the manufacturing business or cultivation business, as well as what does the market say that we can take and make as a royalty payment or fee. Remember, this has to be what we call a reasonable royalty, not just some funky number that you arbitrarily choose out of thin air. There needs to be some basis of why this number is a true and reasonable royalty. So let's break it down. So first, you need to look at what your total projected sales and marketing costs are from that original operating entity. So let's say for this example, this is a manufacturing company and it's projected to generate $20 million in annual revenue. And their sales and marketing expenses is $1.2 million per year. As we said earlier, the intellectual property company will be taking over all these sales and marketing functions. So those are now going to be the IP company's expenses. So understand that this royalty revenue is going to the intellectual property company. So to fully unlock that $1.2 million from 280E and from any taxes, you have to make sure that the intellectual property company has that amount of expenses, the $1.2 million, or at least close enough to it to offset that revenue. So the $1.2 million is your threshold that we are trying to hit in the royalty payment as well as expenses to offset that. Now, the more you spend on expenses with the intellectual property entity, the less taxes that it will have to pay since it's an ordinary business and can deduct all of those costs from revenue to get a taxable base. So understand, we've got these projections. We want to hit a $1.2 million royalty payment to offset all of those sales and marketing costs that we projected. Now, the next step is to take a look at the broader market of royalty payments and of intellectual property licensing agreements and see what is considered a reasonable royalty. Now, when you look at enough of these royalty agreements, you see that there's typically two parts. All right, there's a minimum payment and then some percentage of sales. So in this example with that $20 million company, you may want to set a minimum annual royalty payment of $500,000 or $750,000, maybe even all the way up to $1 million, so that you know that at least this amount is going to be deductible every year. Now, this minimum is going to be different for every business because of the different sales levels or revenue levels of that manufacturing or cultivation business, as well as the value of that intellectual property and many other factors. So it's important that you have these projections done from that previous step because this is an exhibit of your methodology of how you got to that minimum payment. Again, you cannot just arbitrarily grab this payment amount out of the air because you want that number. There has to be some basis to it. Now, the reason for a minimum payment is because until you scale up to, say, that $20 million in annual revenue, you can't charge a percentage of like 30% royalty on those lower end sales numbers. That percentage just does not fit into the contract norms, right? So if you were to charge $1 million on $6 million in revenue, that's not going to look right, okay? So the next step, once you have that minimum payment laid out, the next step is to actually discuss a percentage of sales. So once you actually do scale up to that $20 million, what percent of revenue does the intellectual property company charge the manufacturing or cultivation business? Now, for cannabis, there are not many public markets and numbers around this or contracts that are available for you to look at and create some kind of comparables. But typically, in other lines of business, you see royalty rates from 1 to 5% of sales. But maybe in cannabis, because it's a newer industry, you may be able to get away with something higher, like an 8 to 10%. But again, this is something that you have to do some due diligence on and have some reasonable methodology and basis to why you chose this particular royalty rate. So to tie this example up, if you had a $1 million royalty payment up until the manufacturing company generates $20 million in sales, then you would switch over to a percentage of revenue and you could do 5% of revenue is then the royalty payment going forward on anything above that $20 million in sales. Again, you have to have basis for these numbers, and we're just giving you some color and context that you need to look at. First, what is the amount that we want to hit, and then what is the actual reasonable minimum payment, and then from there, if we exceed that minimum payment, what is the reasonable royalty rate above and beyond some sales level amount for that operating manufacturing business or a cultivation business. So now that you understand what we're talking about here, I just want to give you a basic potential tax savings amount. So we're going to talk about a big operator and a medium operator. So for the big operator, you have the operating company revenue, which is $20 million, the last example we went through. And their annual royalty payment total is $1 million, we'll say. And that tax rate for their business is 30%. So their potential tax savings is $300,000 per year, every year going forward. Now, for a medium operator, say they make $3 million in revenue annually, and their annual royalty payment is $150,000, which is 5% of their revenue. And then tax rate for that business is 30% as well. That's $45,000 per year in tax savings from just this one strategy. So as you begin to look at this and unpack it, there is a lot of money saved for your business in taxes. And the more that you make as a cannabis business, the more that you can save on taxes. Now that you understand the strategy, it's important that you understand your exposure when implementing this strategy. And first and foremost, I want to make it very, very clear. There has not been a tax court case that has been brought up about this strategy specifically for cannabis businesses. There have been other royalty cases and intellectual property cases, but nothing specific to cannabis. And note that this is not some type of cannabis management company style setup that you saw in the alternative healthcare advocates case. Rather, again, this is a pure royalty position. Cannabis management companies usually fail, or those strategies usually fail to stand to the test of the courts for many, many reasons that we detailed in another video, which is linked down in the description below. So we're going to detail 3 ways to reduce your exposure while implementing this strategy. So first, you need to set the royalty rate at a reasonable amount. Again, you cannot set this reasonable royalty at 30 to 35% of sales because that is not reasonable. And no one in any industry does that. So have the minimum fee and then set a reasonable percentage and make sure that you have a very tight, well thought out royalty agreement written by an experienced intellectual property lawyer. And also look at the total royalty rate at an annual rate or an annual period. If you set a minimum payment of $500,000 and the manufacturing or cultivation business only brings in $2.5 million in revenue for that year, that is a 20% royalty rate, and that is just too big. So you got to make sure you have a methodology to work in and get to that reasonable rate that we talked about, the 1 to 5% for typical ordinary businesses, and again, maybe cannabis gets away with something in that 7, 8, 9, 10% range. Next, it's very important that you keep your manufacturing and intellectual property entities and businesses as fully separate legal entities and fully separate businesses in as many ways as possible. They need to have separate books. They need to have separate accounting procedures. They need to have separate business plans. There has to be no commingling of funds at all, which means having separate bank accounts, and also no consolidated tax returns. As well as, you could see some same ownership percentages, but you should consider changing the officers or the managing members, and for sure have no shared staff at all. You may even want to have them be in a totally separate location, a whole different separate office. Now, to make this point very clear, your manufacturing company production manager cannot be the head of sales at the intellectual property company. Again, don't have any workers be employed by both the manufacturing or cultivation company as well as the intellectual property company who does the sales and marketing. Fully separate businesses in every manner possible. And lastly, you want to have well-written standard operating procedures that will qualify as your intellectual property. These things cannot just be up in someone's brain, in the manager or the operating manager's brain. They have to be documented and written out and have a certain amount of specificity to them to become trade secrets. Because again, these SOPs will become your trade secrets, your formulations, and techniques that are then going to be licensed out to your manufacturing business and potentially other people. And where applicable, you could consider filing for patents and trademarks to establish more substantial evidence that these are, in fact, protected pieces of property. Now, to build on this point, if you want to expand your operation to other states and become a multi-state operator or an MSO, then licensing out your IP is how you scale up quickly. And these joint venture agreements with another business strengthen the validity of this tax strategy and this position. So in your home state where you currently operate, you may own both the manufacturing business and the intellectual property licensing company. But in other states where you want to expand, if you have a relationship with a different manufacturer, someone you have no initial ties to other than this business, manufacturing agreement, licensing agreement, then again, you can set up this licensing and royalty agreement with them to produce using your intellectual property, your trade secrets, your formulations, your techniques. Now, when the IRS comes in and questions your position, you can point out that you have this same type of intellectual property royalty arrangement with a second or third cannabis manufacturing company in different states. So if you're based in California, then you say, well, we have this same arrangement with someone out in Nevada and someone in Michigan and then someone in Oregon. This is aside again from that original arrangement that you have in your home state. Having more fence posts to hold up your fence creates this stronger fence and builds a more substantial and stronger argument as to why this position is valid and this strategy is valid for your business. Now, we covered a lot of ground here explaining this strategy, so I want to tie it up with a few key takeaways. So first, understand that intellectual property can include trade secrets, recipes, techniques, and formulations, not just images, trademarks, slogans, logos, things of that nature. Secondly, royalty payments for certain intellectual property can be rolled into cost of goods sold, but you have to have a reasonable methodology for taking that deduction or rolling those costs in. Third, royalty rates must be reasonable and in line with other industry standards. And lastly, well thought out and documented SOPs and other documentation is the first step to developing your intellectual property and can help you become a multi-state operator and grow your cannabis businesses to very new heights. So hopefully you found some value in this video and helped you explain and understand how to reduce your cannabis business taxes with royalty and intellectual property agreements. So if you need help with creating your intellectual property strategy and tax saving strategy for your cannabis business, then please reach out to Green Grow CPAs via our website at greengrowcpas.com or give us a call at 800-674-9050. We can help you walk through and break down your business into chunks and pieces and help you understand where there are trade secrets, what SOPs need to be made, help you understand and create this tax strategy, connect you with the right parties to help you lay out these agreements so that you can save that massive amount of money on taxes every year going forward. Again, if you need help with creating this intellectual property tax saving strategy, then please reach out to Green Grow CPAs via our website at greengrowcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon.